All right, Pacific Trading Academy presents Mentor Mike Bridges, that's me, and Day Trading 101, How to Make a Living in the Markets, Part 2. It is Saturday, June 28th, 2014, and we're getting started here right around 9 a.m. Pacific time. Now, for those of you who don't know me, here's a little biographical sketch. I am a California lawyer who has specialized in financial planning. In connection with that, I've held a number of financial licenses, including Series 3, Commodity Futures and Options, Series 7, General Securities, and Series 66, Investment Advisor. I've also held some California insurance licenses in life, accident, health, and variable contracts. But I have been trading the markets since 1984. And mentoring other traders since 2000. So for those of you who aren't the swiftest with math, that means I've been trading for over 30 years and teaching others for over 14 years. I have been a registered NFA CFTC commodity trading advisor since 2003. My favorite method and market is to day trade the S&P E-mini. That's what we're going to be talking about largely today. My favorite platform is NinjaTrader 7, and my favorite broker is Trenton Kimino of Global Futures right here in Southern California, Encino, California. Okay, now, I have a profile on LinkedIn. That's kind of Facebook for grown-ups. That's my one concession to social media. If any of you out there are members of LinkedIn and have not connected with me already, please invite me to do so, and I will be happy to accept that invitation. I post a lot of information about my trading and upcoming webinars, etc. on LinkedIn, so that's one way for us to kind of stay in touch. And I also, of course, have a blog page on the PacificTradingAcademy.com website, and the address, of course, is PacificTradingAcademy.com, and the way to get there is go to the blog link and then Mentor Mike's Market Movie. And I've been doing this for a number of years, so we have quite a substantial archive of freebies here. Today's webinar is going to be recorded, and you can see the video later on my blog page, and there are a number of other entries there as well. So you don't need any special password or anything to get there. It's all free of charge, and hopefully you can find some very useful stuff. Now, how do you eat an elephant? The answer is one bite at a time. Why do I like to start with this old riddle? Well, because it kind of summarizes my attitude towards the way I teach trading, and it can really be applied to just about anything. Anytime you have a large task like learning to trade, which can seem overwhelmingly difficult at the outset, the key is to break it down into manageable chunks and then just get started. We can apply this proven technique when attempting to make sense of the chaotic motion on a price chart. Now, this presentation, Day Trading 101 Part 2, is, of course, the second of a two-part series of webinars designed to help my fellow traders find answers to the following questions. What markets to watch and trade? What time frames to watch and trade? How to consistently predict market movement? How to maximize your win percentage? How to substitute mathematics for emotions? And how to systematically grow your account from beginner to Mentor Mike's gadget level. Now, for those of you who don't know what gadget is, it stands for Mentor Mike's Grand A Day group of E-mini traders, and we'll talk more about gadget a little bit later on. Now, previously in Part 1, we discussed what markets to watch and trade, what time frames to watch and trade, and how to predict market movement. Now, if you missed Part 1, you can see the video. It's here again on my blog page on PacificTradingAcademy.com. Again, go to blog, Mentor Mike's Market Movie, and then find your way to the entry for June 9th. And all you got to do is hit the video button, and you can watch Part 1. A lot of good stuff in there, and if you haven't seen it already, you don't necessarily have to see it before today's presentation, but the two together will make more of a cohesive whole for you, I think. Now, today, we're going to discuss the next three questions in that list: how to maximize your win percentage, how to substitute mathematics for emotions, and how to systematically grow your account from beginner to Mentor Mike's gadget level. Again, granted a group of e-mini traders. How to maximize win percentage. Well, here's a short list of things that will help you do exactly that. First, become proficient in predicting market movement. Well, one of the ways you can do that is to watch part 1 of this series. Also, understand that statistically, the market makes more small moves than large ones. Next, use the peeling off technique to improve your chances of a profitable trade regardless of the size of the move. Next, create a free trade at your first profit target. And finally, develop your damage control mindset. Now, the market does in fact make more small moves than large. Here's a little mental exercise to illustrate that. Imagine 5 price moves ranging from 1 to 5 points in 1-point increments. Here we have 1, 1, 2, 1, 2, 3, 1, 2, 3, 4, 1, 2, 3, 4, 5. Only 1 out of the 5, that's 20%, went the full 5 points. 2, that's 40%, less than half, went 4 points. 3, or slightly more than half, at 60%, went 3, 80% went 2, and all 5, that is 100%, went at least 1 point. So the bottom line here is that large moves contain small moves, but it doesn't work the other way around. So bottom line is there are more small moves than large moves in the market, and that's just a fact of life. We have to keep that in mind as we go forward with these strategies. Now, you make your profit or take your loss when you exit the trade. So let's talk about exit strategies. There are 3: scalping, swing trading, and peeling off. Let's look first at the scalping exit. This is where you set a profit target, and when the price reaches the target, you bail out of the trade with the entire position. Scalping pros, these are the benefits. Generally, it gets you out of harm's way sooner. Thus, it's less stressful than swing trading. You'll usually earn a higher win percentage than swing trading since, again, markets always make more small moves than large ones. Now, there are some cons. First of all, scalping can leave a lot of money on the table in trending moves. You grab your 2 points, and then the market goes on for another 20 points, and you didn't get any of that. Also, scalping can literally become addictive. And finally, it runs afoul of the conventional wisdom that we've all heard of the importance of letting profits run. The next type of exit is the swing trading exit, and this is where you hold your position in the trade until the market reverses and stops you out. The pros are that it will generally capture any large move, and that it usually produces a higher average win to average loss ratio than scalping. But of course, there are also cons. It generally requires more waiting and thus a lot more stress than scalping. And it usually creates a lower win percentage than scalping because, yet again, markets always make more small moves than large ones. That brings us to the peeling off exit. This is a hybrid strategy that mixes key elements of both scalping and swing trading. The pros are that it increases the chance of a profitable trade whether the market makes a small or a large move. It stacks more contracts on the first target since markets, again, make more small moves than large ones, and it can be used to create a free trade. Okay, we're going to talk more about a free trade in just a second. What are the cons to peeling off? Well, you'll notice I've got the S here in parentheses because I really could only come up with one. And that is that peeling off is a compromise. It sacrifices the potential for maximum gain, which would be scalping all small moves and swing trading all large moves, but it gives us a better chance of medium gain with either small or large moves. Now, the problem is that we can be pretty good at predicting market direction. But the magnitude and duration of the move is much more difficult to predict. There's things we can do to try and estimate what that might be. But in general, once we take a trade, we don't really know for certain whether we're going to be in for a large ride or a small ride. So peeling off increases the chances of a profitable outcome regardless of whether we get the long ride or the short ride. Now, let's talk about that all-important free trade. What is it exactly? It is a multi-contract or multi-instrument strategy where you exit a portion of the position and obtain sufficient closed profit to cover the transaction costs of the entire position. You can then ride the remainder of the position to further upside potential without the possibility of loss. Now, the NFA and the CFTC freak out when they see something like that, where I say without the possibility of loss. So let me clarify. The market can always throw you a curve. There's always the possibility of a loss. But in general, when you correctly exercise a free trade, where you've paid for the transaction costs on the entire position, but you still have part of the position in play, the odds of losing at that point go way, 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 way down. But the chance of further profit is still there. And in addition, the free trade can greatly reduce the stress of trading. Now, you've all heard the old saying, stress kills. Well, the stress of trading is unhealthy for body and mind. Any kind of stress is unhealthy for body and mind. We all know that. But in the case of trading, it also undermines our discipline and makes us do fearful and greedy things. So ultimately, it robs us not only of money, but also of the pleasure of playing and winning the game of trading. And if you're honest with yourself, you'll realize that your fascination with trading isn't just about the money. There's something about the personal challenge of being able to win at the trading game. Now, in a free trade, we have certain goals. We want to set a logical, reachable target that, when hit, earns enough profit to cover the entire transaction cost with a small extra cushion. The extra cushion is going to be used to provide a stop for the portion of the position that's still in play. In addition, once we earn that profit, we've got to automatically move the stop to a position that protects that profit, but still, at the same time, keep the stop as far away as possible from the price action to minimize the chance of a premature stop out before reaching further profit. Now, I'm going to share with you the details of my personal 3-target peel-off strategy. My total position is 9 contracts. Why 9? Well, there's some details involved, but the bottom line is, according to my number crunching, that is the minimum number of contracts one can trade to fully utilize the 3-target capability of NinjaTrader and also create a free trade. So my total position is 9 contracts, and I divide the 9 into 3 groups: 6, 2, and 1. Not 3, 3, 3, 6, 2, 1. I peel off 6, or 2/3 of the total, at the first target. Why so much? Do I have to tell you yet again? Because the market makes more small moves than it does large moves, and there will be a certain percentage of your trades where that first target is all you're going to get. So we peel off the lion's share of the total position at target number 1. In this case, 2/3 of it. We then peel off 2 more contracts, or 2/3 of the remaining 3 that are still in play, at the second target. And we ride the last contract to our third target, or if you prefer, you can turn it into a runner, which is a true swing trade where you let the market dictate how far it's going to take you. Now, we have to calculate the amount of profit needed for transaction cost and cushion, and this is the amount that must be achieved at the first target. So, here's the second part of this strategy. In the S&P E-mini, my broker's commission and exchange fees total $6 per contract. Now that's probably steeper than what you could get if you opened a personal account at Global Futures, my favorite brokerage firm. Why is mine more expensive? Two reasons really. One, all my accounts are corporate accounts, and also I am a registered commodity trading advisor, which means that there's a little bit more paperwork and paper shuffling required by the broker in my case. So my transaction cost is $6 per contract. That covers everything. It's a round turn, all-inclusive, flat rate. So $6 per contract times 9 contracts gives me a total transaction cost for this trade of 54 bucks. So that means enough profit must be earned by the 6 contracts peeled off at the first target to pay the $54 plus an additional cushion to provide a protective stop for the 3 contracts still in play. But the number of ticks in the first target must bear a logical mathematical relationship to price movement. Now, here's where we're going to start talking about another of our subjects for today, how to substitute mathematics for emotions. The 2 areas where our emotions of fear and greed are the hardest to control are 1, setting profit targets, and 2, placing and trailing protective stops. Without the help of an external metric, we tend to set targets too far and stops too near. Now, an external metric is simply a measuring device, that is, metric, taken from the movement of the market itself and thus external to our own emotional mind. Setting profit targets and trailing protective stops. Our 2 external metrics are indicators devised by Wells Wilder, who is the author of The Delta Phenomenon and founder of the Delta Society. And there's the website for the Delta Society if you're not already familiar with it. We set profit targets with the help of Wilder's average true range, also known as the ATR, and we trail our protective stops with his parabolic SAR. SAR, by the way, stands for stop and reverse. Let's talk first about setting profit targets. Our profit targets must be rational and reachable. They must be custom tailored to the market's current volatility. What is volatility? It's the price's ability to move vertically on the price scale within a certain period of time. Steep trends that go up or down in a short amount of time equal high volatility. If you've got a sideways consolidation that lasts for a long time but doesn't produce a lot of up and down movement on the price scale, that equals low volatility. Now, the higher the volatility, the further away we can safely place the target. The lower the volatility, the nearer the target must be. So, the average true range, or the ATR, requires reference to the current price bar and the previous price bar. The current price bar's true range is the longest of 3 distances. The current bar's own length from low to high, or high to low, or the previous bar's close to the current bar's high, or the previous bar's close to the current bar's low. Whichever of those is the longest will be the current bar's true range. Then the average true range is simply a moving average of true ranges. Now here's a little handout that is among the first that my students get, all about the average true range. As you can see, it was written quite some time ago. I've been doing this for a long time, as I've already told you. Now, all of my price charts have the average true range on it. Here's panel number 2, which contains my volume oscillator. And this red line appears to be the 0 line on this oscillator, but it actually isn't. It is the average true range. And the yellow arrow pointing to the little pennant over here is showing what the real important part is. It's not the line itself, it's this numerical value. And this one's a little hard to see, but it is 0.902. And I'm going to use that value in the next slide. So remember, 0.902 is the average true range reading on this particular chart. So how do we calculate the ATR for purposes of setting that all-important first target? Well, the ATR is stated in points. It must be converted to ticks. In the ES, and of course that's the ticker symbol for the S&P E-mini, 1 point, which is worth $50, equals 4 ticks. And each tick is $12.50. Now, 0.902, that's our ATR reading from the previous chart, is obviously more than 3 ticks, because 3 ticks would be 0.75, but it's less than 4 ticks, which would be 1.00. I always round down, never up, always down, to the nearest Fibonacci number, which in this case, of course, is 3 ticks. Also, I will not use a target smaller than 3 ticks. So now, let's see where our auto break-even stop is going to end up. Remember, our total transaction costs are $54. That's 9 contracts times $6 a contract. We're going to peel off 6 contracts at an initial first target profit of 3 ticks. So that's a total of 18 ticks, 6 contracts, 3 ticks, right? 18 ticks times $12.50 per tick gives us a total gross profit of $225. Well, out of that, we have to pay the $54, and that leaves us, in effect, with a net profit of $171. However, we have to use most of that $171 to provide the stop for the remaining 3 contracts that are still in play. Let's figure out how many ticks we can get out of $171. So we divide 171 by $12.50 per tick, and that gives us 13.68 ticks. Now, there's no such thing as a fractional tick, but this is a mathematical exercise at this point, not real life. So the 13.68 ticks that we technically have available to us have to be divided up among the 3 contracts that we still have in play. So that comes out to be 4.56 ticks per contract, or 4 ticks for the stop and 0.56 tick, which works out to be $7, of net profit per contract, or $21 of total net profit for all 3 contracts. So for you NinjaTrader users out there, what I do is I set the NinjaTrader auto break-even function to profit trigger 4 and the plus value to -4. And it looks something like this. This is the dialog box for stop strategies, profit trigger 4 plus -4. Now, imagine that this is a horizontal price scale. 0 represents the point at which we entered the trade. +4 is 4 ticks on the profit side of our entry, and -4 is 4 ticks on the non-profit side. So the 8-tick distance between the profit trigger at +4 and the auto break-even stop at -4 gives the market sufficient breathing room to ebb and flow without hitting the stop. However, if the stop is hit, which happens sometimes, the result is a net profit of $21. Not a king's ransom, but certainly better than a loss. So in other words, we hit the first target and the stop instantly leaps to a point where if it's hit, we haven't got a losing trade. We've got a minimal winning trade, in fact. Now, let's focus on our damage control mindset, because a lot of people ignore this. And we talked earlier about an old trader saying about letting profits run. There's actually 2 parts to that. It's let profits run, cut losses short. Everyone advises you to cut losses short. However, That's a good way to nickel and dime yourself to death sometimes. So the damage control mindset is going to kind of fly in the face of the old adage about cutting losses short, but there's method to my madness, so bear with me. To err is human, and we are all human, which obviously means we're all going to make mistakes. We're going to take bad trades sometimes. But what's important is do not panic. You can fully recover from many mistakes, or at least minimize their negative effect if you stay calm and remember this cosmic truth of trading. The market is constantly oscillating up and down on all time frames. Remember, in an uptrend, you have rallies and pullbacks. In a downtrend, you have sell-offs and bounces. If you're an Elliott waver, you have impulse waves and corrective waves. If you get into a long trade betting that the market is going to go up, but all of a sudden it starts to go down instead, there's a good chance that if you can hang on, it will eventually go up again. Now, there are certain circumstances where that strategy can work. Let's look at some of them. Now, often we'll attempt to enter a trade in the direction of the trend after a corrective bounce or pullback. But we find that we've jumped the gun. The corrective move was not finished yet, and it begins to move against the direction of our trade. Well, it's important to remember, if you hold on, the correction may eventually give way to the trend because corrections tend to break out in the same direction that led into them. Now, this little graphic here is not about Elliott wave per se, but it'll be a good substitute. We have essentially a 5-wave bullish pattern here. So here's wave 1, 2, 3, 4, 5. Let's say that you get in, you see a bullish move, you wait until you feel all your ducks are in a row, and you get long about here. The market goes a little bit in your favor, and then all of a sudden it starts to drop. Now, this happens to a lot of us a lot of the time because we're reluctant to take really aggressive moves. We like to make sure that the market really wants to go in the direction that we intend to trade before we enter. And as a result, we frequently encounter the oscillation against us shortly after we get in the trade. But if you can wait it out, if you can wait out that wave 2 pullback, wave 3 will eventually kick in and make your trade profitable. As a result, having a basic knowledge of Elliott wave theory, especially the corrective waves, can definitely improve your win percentage by helping you know when to hold them and know when to fold them. Now, if your Elliott wave knowledge leaves a little something to be desired, a good place to start is right here. One of my more recent webinars back on April 19th was called Elliott Wave, Just the Essentials. And if you'd like a little primer on how to deal with Elliott Wave or a little refresher, check this out. Again, it's PacificTradingAcademy.com, blog, Mentor Mike's Market Movie. Go to April 19th. Also, by the way, I'm going to be giving a part 2 to this Elliott Wave, Just the Essentials, on July 9th. That particular webinar is going to be sponsored by my friends at Ninja Trader. Also, every day I do an Elliott Wave count of the S&P E-mini. This happens to be my version of the Elliott Wave count for yesterday, this last Friday, June 27th. I send out these charts with my daily email update to all of my students and to anyone else who requests to be on the mailing list. So you're going to learn a lot about Elliott Wave just from osmosis by looking at my charts. Even if you've struggled with it in the past, some of it's going to sink in eventually. And to the extent that you have a handle on Elliott Wave, you're going to be a better trader, and you're definitely going to improve your damage control mindset. Now, here's another aspect of damage control. Sometimes our technical signals point to a new directional turn, And so we take the trade and it ends up going nowhere. In other words, the breakout is a fake out. Well, when this happens, the only damage control strategy really is to bail out and in some cases possibly reverse directions. But you can also sometimes filter out the false breakouts in the first instance by only taking trades where the move is accompanied by rising volume. Now, if your knowledge of volume leaves a little something to be desired, here's another past webinar of mine you should check out. This was my example page for the blog previously. Back on October 12th of last year, this is October 12th, 2013, I did a webinar called POV Trading. POV stands for Price, Oscillator, and Volume. It goes very deeply into volume, how it's used in real time in the S&P. So if you want a little refresher or learn something about volume that you don't already know, Pacific Trading Academy, blog, Mentor Mike's Market Movie, October 12th, 2013. Now, let's come back to that topic of how to substitute mathematics for emotions. In addition to setting profit targets, the second area where our emotions of fear and greed are the hardest to control is trailing protective stops. Left on our own, we tend to place the stops too close to the price action, thus running the risk of being stopped out prematurely. We need a math-based indicator that will keep the stop at a reasonable distance while slowly moving closer over time. Wells Wilder's parabolic SAR, again, SAR is stop and reverse, is based upon the market's volatility. It gives the market sufficient breathing room while describing a parabolic arc that slowly gets closer to the price action over time. It thus creates the perfect guide for trailing the protective stop that eliminates the guesswork of trying to determine where to put the stop and when to move it. Now, this is yesterday's trading, again, Friday, June 27th. Notice my first trade was a short trade here. I got in when the red parabolic flipped from its bullish posture to its bearish posture, giving me a red, white, and blue bearish momentum module. I got short at that point. I only hit one target. I was stopped out on the rebound. And it looked like we were going to reverse to the upside, so I did as well. Hit the first target, the second target, and then I was stopped out. Why? Because I was trailing my stop along with the red parabolic, and it creates a little pennant on the price scale, which I can keep congruent with my stop order. So when the parabolic flipped again, that's where I was stopped out. And good thing, too, because the market went lower after that. When we crossed the trend-defining moving average, flipping the big parabolic, I got short. Now, when the red parabolic flipped the first time, I hadn't hit my first target. So I rode through it, and eventually the market fell off the cliff, and I hit two more targets, and then I was stopped out once again after the parabolic flipped. Now, here, this little trade here is going to serve a couple of purposes. First of all, I got in here when, again, the big parabolic flipped, and I ended up hitting all three targets. So really, the red parabolic didn't come into play in terms of trailing my stop. But what I wanted to tell you was this is a good example of how knowing something about Elliott wave theory will sometimes allow you to snatch victory from the jaws of defeat. Here I got long right here. And you can see the market kind of clung to the trend definer. It popped up, and at this point I'm thinking, yes, I'm going to be okay. Then there was this major pullback. Well, I rode through the trade and ultimately hit all three targets. I could have bailed out in panic and taken a loss, which would have gone a long way towards eating up a significant portion of my three winning trades prior to that. But instead, I elected to hang in there, and I ended up adding to my position quite substantially. Now, what made me hang in there? Well, basically because as the day was progressing, I was keeping tabs of the Elliott wave count on my day session only chart, and it looked to me like the most logical configuration was this. The market ended on a high the day before, which meant that this was probably wave 5 of a bullish pattern. Ultimately, I concluded that we had a wave A, B, and C, a large corrective move, which meant that the market was now going to go up and begin a new bullish pattern. Well, this appeared to be wave 1, which made this wave 2. Wave 2 will never retrace more than 100% of wave 1, which began right here at this truncated wave 5, in my estimation. And that actually rarely happens. Usually wave 2 doesn't retrace that far. It could theoretically, but I didn't really see that happening because I didn't think it was going to go far enough to flip this big parabolic. Why? Because the big parabolic changes when we cross the trend definer, as it did here and here and here. But at this point, it was a little too far away for that to happen. So I knew that there was a pretty good chance that this thing would bottom out and turn around. In addition, there's a little something called the guideline of alternation that says that of the corrective waves 2 and 4, one tends to be a little more complex, the other one tends to be simple. In my experience, 4 tends to be the complex one, and 2 tends to be the simple one. Now, that's not always true, but statistically, that's how it seems to play out in my experience. So, for all of these reasons, I made the election to hold this position. If it had gone much more and flipped this parabolic, I would have been slightly in the hole and might have been able to end the day marginally in the money. But instead, I stuck in there because of my knowledge of Elliott wave and took no loss and, in fact, hit all 3 targets. So how does one do that? How do you build up that kind of damage control mindset? Well, let's talk about growing the account. That's a good segue into that. Here are some figures that are important to know. $400 is the minimum day trading margin per S&P E-mini contract in those few brokerage firms that cater to the day trading crowd. You're not going to get this day trading margin anywhere. Global Futures, the firm that where I have my account and where I always recommend my students, has a $400 margin on the S&P E-mini. There's one other brokerage firm that I know of that does that. Most others do not. But having a low margin is one of the attractions to trading, day trading, the S&P E-mini. By contrast, by the way, the overnight margin, the so-called exchange minimum, is probably about $4,700, $4,800. So you can see that day trading really gives you an opportunity to get in the game with less capital exposure. That doesn't mean you should, however. Now, at Global Futures, I believe the last time I checked, the minimum amount to open an account was $500. So you got $500 to open the account and $400 as the minimum margin for the S&P E-mini. But obviously, you're not going to start with that amount. You've got a $100 cushion, and let's face it, everybody's going to take a hit sometime. So your chances of success beginning with that little amount of capital are pretty much nil. My absolute bare minimum amount that I recommend per S&P contract is $1,000 per contract. If you want to start with the peeling off strategy, you can actually do so with $3,000. You can start with 3 contracts, which will allow you to use 2 targets. And even then, it's kind of dicey. $3,000 per contract is really what we might call one's preferred minimum. Now, the more capital that you can have at your disposal, the better trader you're going to become, because here's something that often gets glossed over or ignored altogether, but something you really need to appreciate, which is trading is gambling, and scared money never wins. Now, we're professional gamblers. Not all gambling is pure chance. You know, spinning a roulette wheel, throwing dice, those are pure games of chance. Poker, most card games, backgammon, and trading require choices and strategy on the part of the player. So it's a step up. It's a much more complicated game, but it is still trading and gambling. They're the same. Sometimes I like to use the word wagering. It sounds a little more genteel and gentlemanly, but it is gambling. And professional gamblers have this great saying that scared money never wins. If you got to win to pay the mortgage next month, it ain't going to happen. You will be so nervous and so tense that you cannot perform at your best. You've got to be able to take a hit once in a while and know that you can come back from it and stay in the game. If you have to win to survive, you won't. It's just that simple. So when they say that you should only trade with risk capital, what it means is you're going to have to take risks, and you better have plenty of capital. That's pretty much the bottom line. Now, it doesn't mean you can't learn how to acquire these skills as you're saving your money. That's a good plan, in fact. But I don't ever recommend to my students that they take the plunge into real money trading until they have a sufficient capital base. And same goes for you listening in Webinarville today. All right, now let's get to a happier note about growing the account. Remember, professionals get paid. As you are growing your account every month, when you're profitable, pay yourself at least 1/3 of your net profit, no matter how much or how little. Your first withdrawal of trading profit is an important rite of passage. It symbolically marks the point where you are no longer just becoming a professional trader, you are now actually being a professional trader. Now, I'm looking for a few good traders to join my gadget group here, the Grande group of E-mini traders. I can absolutely make no guarantees, but my personal goals are these: to help every student become a competent and confident trader with a win percentage of 90% or better, to help most students earn enough to pay for the course within 3 months, to help some students earn $1,000 per day or more within a year, to help a few students earn $1 million within 5 years. Now, I am perfectly serious about that, so if you are interested, there's the link. Now, $1 million in 5 years? Come on. Well, the more important question is the $1,000 per day. If you can average $1,000 per day, you're going to be making about $250,000 a year. So to make $1 million in 5 years would be doable if you can maintain that average. Now, this link will take you to this page. And again, Pacific Trading Academy, this time enrollment and Mentor Mike's mentoring course and trading room. This tells you all about the course and the trading room. And when you're ready, click on price and payment plan. Here's what it costs and how you can pay. And here's the form you fill out to make it all happen. Now, to give you a quick summary of it all, this is what you receive. 3 months access to 8 video lessons produced by me. Plus, of course, you have all the freebies on my blog page archives. You get 12 one-on-one phone conferences with me. Now, if that doesn't sound like enough, let me tell you, most students don't even get up past 7 because between the videos and the live trading room, they don't really need to talk to me that much. But you can have 12. In fact, truth be told, if you need more than 12, I'd be happy to talk to you, as long as I know that you're really doing your best to move forward. So you get 3 months of access to the lessons on video, which you can watch over and over again. You can repeat that information until it really sinks into the old memory banks. If you've got questions, you want to delve into the details more, then you use your phone conferences with me for that purpose. And in addition, for 3 months, you have access to our twice a week, every Tuesday, Thursday, live trading room. We watch the market in real time from 7 a.m. till noon Pacific time. You can come and go as you please, and I will take trades in the room, explaining as fully as possible what signals I'm relying on and what my strategy is. In addition, I send out daily email updates that usually contain screen captures of my personal trading, the trading room chart, the Elliott wave count chart, and any charts that are sent to me by any of my students. Now, the one thing that you can get without being a full-fledged student is the daily email update. If you'd like to receive that and be able to see our charts on a regular basis, we'll talk more about how you do that in a moment. Also, we have an optional month-to-month extension in the trading room. If after 3 months you find you like it, and a lot of people do because it's a good supportive atmosphere of like-minded folks, all there for the same reason, to learn and profit, well, it only costs you $100 a month. So here's what it costs for the whole kit and caboodle. The all-inclusive tuition is $4,990, payable $29.95 down and $19.95 in 30 days. The optional trading room extension, $100 a month, and that's also true for any Pacific Trading Academy graduates. Even if you weren't my student, if you worked with another mentor, but you'd like to participate in the trading room, $100 for you as well. Okay. Now, the big question is, a grand a day really a realistic goal? Well, let's take a look at my trading for this past week. This happens to be Tuesday. I didn't trade on Monday because, as some of you know, I had some problems with my internet service provider, who also happened to be my phone and cable TV provider. And by the way, if any of you had signed up for part 1 and came out on that Saturday morning only to find out that I wasn't going to be able to give the live presentation, I most humbly apologize for that. Hopefully you had a chance to see the video later on, but that was thanks to my service provider. Well, that's been changed now. So in any event, a lot of that was going on this past Monday, so I didn't dare trade since my service was intermittent. So you're looking here at Tuesday, 2 trades, $1,079.50. And again, these figures are net of the $6 per contract transaction cost that we spoke of earlier. Yeah, there's Tuesday. Here's Wednesday. 3 trades. Had to stop at this point because something was going on. Don't remember exactly what. But we made $838 that day. This is last Thursday, the 26th of June. This was trading room day, and I made $1,542.50. And this was Friday. We've looked at this chart previously. $1,521.50. And these are the totals for that 4-day week of mine. And as you can see, my average per day was in excess of $1,200. So the answer is yes, it is possible to make over $1,000 per day. You're not going to do that scalping one contract. You're going to have a sufficient number of contracts, obviously, to reach that level, but it is doable. Now, this is the text from the email update that I sent out last Thursday. In the trading room, we only earned $638, but that's because I had taken a couple of trades earlier in the day before the trading room opened, and that's what gave me my higher total in my personal account. Now, I didn't include the attachments, but on this particular email, there was my personal chart, there was the trading room chart, and there was my Elliott wave count chart. So there's always attachments to every one of these emails. And again, if you'd like to get on the mailing list, I'm going to show you how to do that in just a second. Here it is, in fact. If you have questions or comments, if you would like to be added to my emailing list to receive my daily email updates, please contact me at mentormike@charter.net. Now, any of you who have been to previous webinars know that this is a new email address. I went from AT&T to Charter Communications. Previously, I was mentormike@sbcglobal.net. If you use that one, it's not going to go anywhere. So if you have me on in your address book, please make this change. mentormike@charter.net. When you contact me, please include your phone number and your time zone, or better yet, become my student and enroll now. Now, I want to leave you with something else to think about. Something called the 80-20 rule, also known as the Pareto principle, also known as the law of the vital few. It means that in most events, roughly 80% of the effects come from 20% of the causes. This rule can be applied generally in most aspects of life. In a company where there is a large sales force, for example, it is usually the case that 20% of the salespeople are making 80% of the sales. And in trading, it means that 80% of traders consistently lose and 20% consistently win. Now, you can take that even down to another level. Within the 20% who consistently win, 80% are marginally successful and 20% are very successful. You can make that division just about anywhere in any aspect of life. Well, my goal is to teach my students to be in that 20% that consistently win. But I can't work miracles. I can only work with what I start with. And the sad reality of life is that not everyone has what it takes. So all of you out there, if you're contemplating working with a mentor, whether it be me or anyone else, you really need to do some honest introspection. Are you going to be in the 20% or the 80%? Well, most people who get into trading have been pretty successful in other parts of their life. But again, do a really brutally honest assessment. If you're in the 80%, then cut your losses. Don't waste any more time going to these webinars, and don't spend your money on an expensive course. But if you truly believe you're in that 20%, then you need to invest in yourself, and better you do it now than later. So there it is once again, folks. That's the page you want to get to. PacificTradingAcademy.com. Enrollment, Mentor Mike's mentoring course, and trading room. Now, there's a lot more information about the course and so forth here that we didn't get into today. So if you have any curiosity at all, I really recommend that you go there. Now, we've got a few minutes left in our hour presentation, but I'm going to cut it off here. Again, if you have a question for me, just send it to me at mentormike@charter.net, and I'll be happy to give you a nice, thorough answer. But we're going to call it quits for today. Go out and enjoy the rest of your Saturday. And I want to thank you once again for coming out to see us today. Take care, and keep tabs on my next webinar coming up. It'll be part 2 of Elliott Wave, Just the Essentials, on July 9th.